I want to start this deep dive with a hypothetical scenario. It's a little strange, so bear with me.
Okay, I'm ready.
I want you to imagine you own a farm. Or, since most of us aren't plowing fields, let's say you own a share of a decent business that you bought for, say, $1,000.
Okay, I've got my $1,000 stick. I'm picturing it.
Now, you have this neighbor. We'll call him Mr. Market. And honestly, this guy is a lot to handle.
Oh,
He is arguably the most emotionally unstable neighbor in history. Every single morning, without fail, he bangs on your front door.
that sounds annoying already.
It gets worse. He has a very strong opinion about what your farm is worth. But the catch is, he is wildly bipolar. One day, he's euphoric. He sees rainbows. He thinks corn is the future of humanity. And he offers to buy your share for $2,600.
That's a nice profit on my $1,000.
It is. But the very next day, he shows up depressed. He's practically crying, claiming the sky is falling, the crops are dying, and he'll only offer you $500.
Okay, so I assume nothing actually changed on the farm overnight. The corn didn't just wither and die in 12 hours.
Nothing changed. Same crops, same dirt, same business. Only his mood changed. Now here is the problem most of us face in the real world. Instead of ignoring this crazy neighbor,
We listened to him.
we let him dictate how we feel about our own wealth.
Right. It's a psychological trap. When he's screaming that the world is ending, we panic and think he must know something I don't, so we sell our farm for cheap.
And when he's euphoric, we get FOMO and buy more at the top because we think the party will never end.
We let the maniac run the asylum.
But today, we are going to fire that neighbor. We are doing a deep dive into the book that Warren Buffett, a man worth roughly $145 billion, calls by far the best book on investing ever written.
We are talking about Benjamin Graham's The Intelligent Investor. And it's worth noting, Graham wasn't just some academic. He was Buffett's mentor. He was the guy who taught the guy.
And our mission today is pretty specific. We aren't trying to make you a day trader. We're trying to decode Graham's framework, the one that separates investing from speculation, so you can keep your emotions from, torpedoing your financial future.
And I really like how Graham frames this. He says, you don't need a stratospheric IQ to do this. You don't need to be a math wizard. You just need a sound intellectual framework
And the discipline to stick to it.
and the ability to keep your emotions from corroding that framework.
So let's go back to that Mr. Market allegory, because it really is the foundation of everything Graham teaches. It sounds simple, but I feel like it's so much harder to practice than it sounds.
It is, because our brains are wired to follow the herd. But the core insight Graham is grilling into us is that price and value are rarely the same thing.
Okay.
Mr. Market is there to serve you, not to guide you.
Serve, not guide. That's a critical distinction.
It means he never forces a deal. He just makes an offer. If he offers a stupidly high price, maybe you sell to him.
Yeah.
If he offers a stupidly low price, you buy from them.
And otherwise.
You ignore him. He's just noise. Close the door and have your coffee.
Which sounds great in theory, but when you open your brokerage app and everything is flashing red, it feels very different. It feels like the business is failing.
It feels like you're losing real money. That's the illusion. But history proves Graham right over and over. I mean, look at the dot-com bubble.
Right.
In March of 2000, Mr. Market was euphoric. He valued a specific business share at $2,600. 1 year later, March 2001, he's depressed and offering $500.
And just to be totally clear, the business didn't collapse during that year.
No, that's the kicker. In that same period, the company's income actually grew by 50% and profit went up 20%.
So the business got better.
Objectively better, but the price crashed by 80%.
That is wild. So if you listen to the price, you'd think it was a disaster, but if you looked at the value...
You're getting a bargain. We saw this even more recently. Look at American Express during the 2008 financial crisis.
Oh, right. I was looking at the notes on this. That was a bloodbath?
Absolute panic. American Express stock dropped 75% in under a year. Now, if you're an intelligent investor, you have to stop and ask yourself, did the global network of credit card processing just evaporate?
No.
Did humans stop spending money forever?
No. People still use their cards, but fear took over the narrative.
Fear took over. But if you were the calm investor who bought when Mr. Market was screaming fire, you'd be up, what, 2,500% today?
Or look at Marriott in 2020. The pandemic hits, travel stops cold. Mr. Market drops the stocks 60% in 6 weeks.
Which, to be fair to Mr. Market, felt rational at the moment. Hotels were empty.
Sure, but was the brand worth zero? Was the real estate worth nothing? Seems like people forgot that pandemics, they eventually end.
Exactly. People who bought when the market was paranoid saw 330% returns in just 4 years.
So the takeaway is that the intelligent investor looks at stocks as ownership in a real business.
You have to ask, would I buy this whole business? If the answer is yes, the daily price fluctuation shouldn't scare you. It's just your neighbor having a bad day.
Okay, so we've established that the neighbor is crazy, and we shouldn't listen to him. But that begs the question, what do we actually do? How do we construct a portfolio if we aren't chasing the squiggly lines on the chart?
Graham breaks investors down into two very distinct camps. And this is where most people get tripped up because they think they are one type when they are actually the other.
Okay.
He divides them into the defensive investor and the enterprising investor.
Let's start with the defensive investor. And to do this, I want to walk through a case study from our research. Let's talk about Tom.
Ah, yes. Tom, the unexpected hero of this story.
So Tom is an engineer at General Motors. He didn't have a background in high finance, didn't come from money started with literally $0.
A regular guy.
A regular guy. And frankly, Tom started off making mistakes. He fell into what the sources call the fermented fish trap.
The fermented fish. I love this analogy.
For those who don't know, it's a Swedish thing. Surströmming. It's fish that has been fermented for months.
And it smells awful.
Apparently, it smells like death. And in investing, fermented fish refers to bad risks that smell fishy, but people eat them anyway because they want the rush. Tom initially read some books, got excited, and threw his money into speculative nanobiotech stocks he found on Reddit.
Classic mistake. He was chasing the hot thing. He made money fast, felt like a genius.
And then lost 60% of his capital just as quickly.
He was eating the fermented fish.
But Tom was smart enough to stop. He realized he wasn't a speculator, he was a defensive investor. He wanted safety and freedom from constant effort. He didn't want to stare at charts all day.
And for a defensive investor, Graham lays out a very specific, almost mechanical set of rules. The goal is to avoid big mistakes and get a decent return with minimal effort.
Is this just buy and hold?
It's a bit more nuanced. First, asset allocation. Graham suggests a 50-50 split between stocks and bonds.
And you rebalance that, right?
Yeah.
You don't just set it and forget it forever.
Right. Say stocks go on a tear, like a bull market, and you're suddenly at 60% stocks. You sell the excess and buy bonds to get back to 50-50.
I like that because it forces you to be contrarian. You're automatically selling high and buying low without having to make a prediction.
Exactly. It removes the psychology. Now, regarding picking the actual stocks?
Right. Tom didn't just buy a lottery ticket.
No. Graham suggests diversification holding 10 to 30 companies. Now, today, you'd probably just buy an S&P 500 index fund to achieve this easily.
Much easier.
But Graham had specific quality filters if you were picking individual stocks. He wanted size and stability. He defined large as having over 100 million in yearly sales back then, adjusted for inflation. That's about 700 million today.
So no tiny startups and no companies that are pre-revenue, which seems to be half the tech sector these days.
Exactly. He also insisted on conservative financing. Their current assets should be at least twice their liabilities. And get this, they should have paid dividends for 20 years straight.
20 years? That's a high bar. That basically filters out any company that hasn't weathered at least 2 or 3 recessions.
Which is the point. You want survivors. And finally, valuation guardrails. Don't overpay. Graham says the PE ratio, price to earnings, shouldn't be higher than 15.
Can we pause on PE for a second? I feel like people hear that term and just their eyes glaze over.
Sure. Think of it like buying a rental house. If the house generates $10,000 a year in rent and you pay $150,000 for it, your PE is 15. It takes 15 years of earnings to pay back the price.
That makes perfect sense.
But if you pay a PE of 100, you're paying $1 million for that same house. You are speculating on massive future growth that hasn't happened yet.
So Tom followed this. He used dollar cost averaging, putting a fixed amount of his salary into these boring, stable investments every single month, regardless of what Mr. Market was doing.
And that consistency is key. He wasn't trying to time the market. He was just accumulating assets.
Now, I want to contrast Tom with his friend Stephen, because Stephen represents the other side, or at least what people think is the other side.
Stephen represents the danger of confusing enterprising investing with straight-up gambling.
So Stephen calls Tom up with a hot tip. He's investing in a startup called Walmeta.
Let me guess. The Walmart of the metaverse.
You got it. And Stephen actually makes fun of Tom for investing small, boring amounts. Stephen goes all in. And briefly, Stephen looks like a genius. Walmeta goes public, and he hits a 2,400% return. He retires young.
This is honestly the worst thing that can happen to a new investor, making a lot of money on a bad process. It convinces you that you're smart when really you were just lucky.
Because what does Stephen do next? He takes all that money, his entire nest egg, and puts it into Starverse.
The Starbucks of the metaverse.
Of course. And I assume that didn't end well.
Total wipeout. He lost everything and had to go back to work.
That really illustrates Graham's warning about growth stocks. When you buy a company purely because of what it might earn in the future, like a metaverse startup, you are speculating. You are paying for reliability that doesn't exist yet.
But Graham does say there is such a thing as a true enterprising investor, right? Someone who can beat the market.
Yes, but he sets the bar incredibly high. A true enterprising investor isn't just gambling on hot tips. They are doing deep, deep work.
Yeah. It's a full-time job. Graham liked to look for companies trading below their net working capital.
Unpack that for us. What does that actually mean?
Think of it as the liquidation value. You take the cash, the inventory, the receivables, and you subtract all the debt. If the stock price is lower than that number.
Wait, so you're buying $1 for 50 cents?
You are essentially buying $1 for 50 cents. You're getting the buildings, the machinery, and the brand for free.
That sounds amazing. Why doesn't everyone do that? Who leaves free money on the table like that?
In the 1930s and 40s, you could find them. Today, algorithms usually snap those up instantly. It's incredibly rare.
So for 99% of people listening, trying to be enterprising usually just leads to mistakes.
It leads to behavioral traps like the home bias.
Oh, the home bias. That's the buy what, crap, right? Peter Lynch made that famous.
It is, but it can be really dangerous. People think, I work at this company, I know it's good, I'll put all my money in it.
Like the employees at Enron or Signature Bank.
Total tragedy. They had 25, maybe 30% of their retirement in their own company's stock. When the company failed, they lost their job and their savings in the same week.
That is terrifying. It's putting all your eggs in one basket and then dropping the basket.
Exactly. Familiarity breeds complacency. Just because you know the company culture doesn't mean you know its balance sheet. So unless you are willing to analyze financial statements for 40 hours a week, Graham strongly suggests you stick to the defensive strategy like Tom.
Now, speaking of risk, I think we need to shatter a massive myth here. We're taught in finance, and in life really, that higher risk equals higher reward. If you want big gains, you got to take big risks.
And Graham completely disagrees. In fact, he flips it on its head.
The source used a pretty intense analogy for this. Russian roulette.
It's graphic, but it works. Imagine someone offers you $10,000 to play Russian roulette once. One bullet in the chamber. That's a 16.7% risk of, well, game over.
Pass. Hard pass.
Right. But then they say, okay, how about $100,000, but you have to pull the trigger twice.
So the reward is 10 times higher, but the risk is now 33%.
According to standard academic theory, that's a fair trade-off. Higher risk, higher potential reward. But in reality, it's just stupid. Investing shouldn't be Russian roulette.
So how does Graham view risk?
In value investing, lower price actually equals lower risk and higher reward.
How does it work?
Think about it. If you buy a dollar bill for 60 cents, your risk is low because you have a buffer. If you buy that same dollar bill for 90 cents, your risk is higher and your potential profit is lower.
This leads us to the concept that Graham says is the secret to everything, the margin of safety.
The three most important words in investing.
I love the bridge analogy here. If you're an engineer building a bridge that can hold 30,000 pounds.
You don't drive a 29,000-pound truck over it. You limit it to 10,000 pounds. You leave a massive buffer for things you can't predict. Rust, wind, heavy traffic.
So applying that to stocks, if you calculate a company's worth $31 a share, you don't buy it at 30.
No, you buy it at 20. That $11 gap is your margin of safety. It protects you if your calculations are wrong, or if the economy tanks, or if management messes up.
Without that, you have to be perfect.
And no one is perfect.
Graham actually had a formula for this, didn't he? To calculate intrinsic value.
He did. It's a bit technical, but essentially, value equals current earnings times 8.5 plus 2 times expected growth.
We don't need to memorize the math. What's fascinating is when you apply this backwards to see what the market is thinking.
Right. Look at 2018. If you plugged in the stock prices for Amazon and Apple, The market was pricing Amazon as if it would grow 74% a year.
74%.
And it was pricing Apple as if it would grow 5.8%.
That is a massive discrepancy.
It shows how the market prices expectation, not reality. And here's where the 2 times expected growth part of the formula kills you. A 74% growth expectation leaves 0 margin for error. If Amazon grew at 50%, which is an amazing number, the stock would still crash because it missed the expectation.
That is a bridge with no margin of safety.
Exactly.
So we've got the theory, we've got Mr. Market, we've got the defensive approach, we've got the margin of safety. But let's bring it back to Tom. How did this regular guy actually hit a net worth of $1 million by age 43? Because it wasn't just stock picking.
No, it was lifestyle and habits, the soft skills of finance.
There was a moment in the story where Tom's parents offered him $10,000 to help buy a house early on, and he said no.
He did. He was channeling a bit of Robert Kiyosaki there. A house is a liability. But more importantly, he didn't want to interrupt the compounding process. He knew that $10,000 invested in his 20s was worth hundreds of thousands in his 40s.
And while his colleagues were buying Teslas and going to expensive dinners to show off,
Tom focused on the idea that wealth is what you don't see. If you spend money to look rich, you are literally becoming poorer.
there's a quote from Charlie Munger that came up in Tom's journey regarding the first $100,000.
Ah, yes. Munger famously said the first $100,000 is a bitch.
He didn't mince words.
He didn't. He said you have to do whatever it takes. Walk to work, use coupons, eat simply. Because until you have that critical mass of capital, your money isn't working hard enough for you.
It's not a big enough snowball.
But once you hit that 100K, the snowball starts rolling on its own.
It's escape velocity.
Exactly. And the real test for Tom came when the market crashed. The S&P dropped 50%. Tom was technically back below his 100K milestone.
Most people would puke. They'd sell everything to stop the bleeding.
But this is where the Mr. Market training kicked in. He didn't panic. He quoted Graham. Buy stocks the way you buy groceries, not the way you buy perfume.
That is such a good mental switch. When perfume goes on sale, you might think, is it old? Is it knockoff? You judge the quality by the price.
But when steaks go on sale, you fill the freezer. A bear market is a sale on earnings. Tom bought aggressively when everyone else was selling. And because of that, his returns jumped to 30 and 45% in the following years when the market corrected.
So if we zoom out, what does this all mean for the person listening right now?
It means that investing isn't about beating the guy next to you. It's not about finding the next Walmart of the metaverse. It's about having a plan that fits your psychology.
Whether you're a defensive investor who just wants to dollar cost average into an index fund and sleep well at night,
or that rare enterprising investor willing to dig through balance sheets to find those networking capital bargains.
the key is sticking to it.
And ignoring the neighbor banging on your door.
So let's recap the big takeaways from our deep dive into the intelligent investor.
1. Don't let Mr. Market's mood swings dictate your financial life. He serves you, you don't serve him.
2. Insist on a margin of safety. Build that bridge to hold 30,000 pounds, but only drive a small truck over it.
3. Risk and reward are not always correlated in the way you think. In value investing, paying a lower price reduces your risk and increases your potential reward.
And 4. Time in the market beats timing the market. Compounding needs time to work, and the first 100K is the hardest part.
Just get through that first 100,000 however you have to do it.
Which brings us to a final thought to leave you with.
I want you to look at your portfolio or your savings account, wherever your money is, and be honest. Are you holding fermented fish?
The smelly stuff.
Are you holding speculative bets that you bought just because they were going up? Or are you building a bridge with a margin of safety?
And are you buying stocks like perfume for the prestige and the high price tag? Or are you buying them like groceries, stocking up when the price drops?
It's a simple shift in mindset, but it's the difference between retiring at 43 like Tom or going back to work like Steven.
That's it for this deep dive. Thanks for listening, and we'll catch you on the next one.
Keep learning.